Hey, it's time for our April update of our $121,000 TFSA dividend stock portfolio. In this video, we share our 17 holdings and which stocks we continued to buy during these uncertain times. Let's do this. For those that are new to the channel, welcome. My wife and I do our finances together. We have 3 accounts through 2 brokerages for our TFSA, Scotia iTrade and Wealthsimple. As you can see in our Wealthika account, the month of April has been pretty good considering the macro conditions. We finished April up 4.6% or $5,300. This beat the S&P 500's 1.5% gain on the month. After thinking the global banking crisis had been averted, there was more turmoil in April, but not to the extent of March. If anything, there is way more talk about the US debt ceiling and the fact that the market is thinking inflation is beat and rates are going down. My opinion is this is a false hope. CPI data is down year over year when compared to the craziness of March 2022, just after the war in Ukraine broke out. Enough about the market in general. We're here for the update. So let's start with our only ETF in our TFSA. VFV, Vanguard's non-hedged S&P 500 index ETF. VFV still makes up a tiny 0.2% of our portfolio. It is up a bit better than the benchmark this month because of the Canadian dollar. We still have an allocation target of 5% and haven't budged towards it yet. I still feel there are better options for us in the market at present with the same amount of capital protection as this index ETF that is trading at a PE of nearly 24. Next, CANOE EIT Income Fund makes up 2.5% of our portfolio. It is up 3% on the month. This is a well-run income fund that I can't get myself to sell. It currently has 20% financials, 20% energy, and 17% healthcare. It has had a 14.6% 5-year return, or in other words, it's doubled in that time frame. Next, TD Bank makes up 2.6% of our portfolio. The beginning of March saw the financial sector get hit hard with the global banking crisis that just kept on giving great deals. And then TD became the most shorted bank in the world in April. Earnings won't be reported until the end of May. The market is anticipating a decent report. I personally think the year over year will be just as bad as last quarter. The month of April proved to be quite flat for the stock price in spite of all the noise around them. We nibbled 3.38 shares at an average cost of $81.12. This added $12.97 to our forward annual dividend income at a yield of 4.7%. We still need to triple our share count to get this to where it belongs. Next up is FIERA Capital. It represents 3.2% of our portfolio. FIERA finished the month down 4%. The longer I've held this since wanting to sell, the worse the situation has become. Q1 earnings will be released next month. Hopefully they can slowly build up their AUM again and maintain their income to pay the dividend. As you can see, with a yield like that and a payout ratio that keeps increasing, a dividend cut may be on the horizon. That would only increase the pain for FIERA. If you enjoy these kinds of updates, we'd appreciate a light tap of the like button. And please share your thoughts on the updated slides in the comments below. Next is our renewable energy play in the utility sector, ALGONQUIN Power and Utilities Corp. It makes up 4.2% of our portfolio. ALGONQUIN is up 2% on the month. Q1 will be announced in May. It'll be interesting to see the progress they're making in selling down their non-core assets. For anyone following this stock, the big news was the announcement on April 17th that AQN and American Electric Power mutually agreed to terminate, yes, that's right, to terminate the Kentucky Power transaction. The CEO took that opportunity to reaffirm their 2023 earnings guidance. This is trading around fair value to me. We dripped 2 shares at a sky-high price of $11.88, adding $1.16 to our forward dividend income at a yield of 4.9%. Next, we have MANULIFE Financial Corporation at 4.8% of our portfolio. It finished the month up 8%. I should have done some buying when it hit our average cost per share at the end of March during the banking crisis. In any case, this has a great dividend growth rate of 10% over the last 5 years and is trading on the cheap. The low 40% payout ratio gives MANULIFE a lot of room to grow in the near future. It'll be interesting to see what earnings look like next month. I know this may sound redundant, however, I can never thank everyone enough for joining us on our TFSA investing journey. We have almost 1,300 subs on YouTube and now have over 1,600 followers on Blossom Social. You totally should download the free mobile app for DIY investors using the link below if you're not on there yet. Not only can you follow my portfolio live and learn from 20,000 other Canadian investors, you can also earn some cash when you complete some basic investing courses. I hope to see your posts on Awesome Blossom. Now, back to the portfolio. Next up, at 5.7% of our portfolio, we have BCE Inc. We are basically at our target allocation of 6%. It finished April up 8%. Ironically, this coincided with the Rogers and Shaw merger happening at the beginning of the month. Next month, we get to see its earnings. This should have no problem weathering a downturn in the future. As a toll booth type of revenue stream, I see this continuing to grow its dividend in the 5% range. It is still very high yielding with its dividend, but with a payout ratio in the high 70% range, they are well supported. We dripped one share at an average price of $64.01. That added $3.87 to our forward annual dividend income at a yield of 6.1%. Next up, we have TELUS Corporation at 5.7% of our portfolio, just slightly more than BCE. After the pullback, TELUS finished the month strong, just like BCE Inc., up 7%. It will also be reporting earnings in May. I love TELUS for its growth potential. It has a 5-year CAGR on its dividend of 6.6% and a low payout ratio of only 62%. I do not expect them to miss on their 7 to 10% dividend growth guidance. They are just 1 year shy of 20 years of dividend growth. After adding a lot in the first quarter, we didn't add to our position this month. Next, we have our first midstream pipeline, PEMBINA Pipeline Corp. It represents 6% of our portfolio presently, finishing the month up 2% after that massive 10% drop in the middle of March. Next month, it will report Q1 earnings. They should continue to be in line with analysts' expectations as the bar has been set pretty low across the market. As I mentioned last month, this hasn't dropped to near our book value in quite some time. We'll look to add to this position around $40, as it has been almost a year and a half since our last purchase back at the start of 2022 when we were maxing out our TFSA contribution room. Next is Fortis, our steady Eddie. It represents 6.2% of our portfolio after the recent run-up in share price of 11% since March 1st. It'll be interesting to see if this continues to run up in price. This is not normal for such a low beta stock like this. Fortis has a 5-year CAGR on its dividend of 6% and has guidance to continue a 4 to 6% growth until 2027 with current CapEx. This month, we did not add to our position, though we need to add a lot to bring it in line with Capital Power Corp. Next, we have our OG pipeline, ENBRIDGE, at 6.5% of our portfolio. It traded up 5% on the month. ENBRIDGE will be reporting its Q1 earnings at the beginning of May, like the rest of our portfolio as I keep mentioning. This is a high yielder at 6.6%, with a 5-year average yield of just the same. Its growth has slowed down lately with its most recent dividend increase of only 3.2% compared to its 7.3% 5-year CAGR. It still has a modest payout ratio on CFPS. Similar to PEMBINA, we haven't added to this position since December of 2021. As I mentioned last month, we'll be looking to add to our position at the next sign of weakness as we did with TC Energy Corp and match their weighting as we max out our TFSA. Next up is SmartCentres Real Estate Investment Trust at 6.7% of our portfolio. It lost another 2% this month. It is being heavily impacted by the banking crisis as well as the poor state of the real estate market in Canada. Fortunately, SmartCentres has only one office property in their portfolio. It has a yield of 7% or about 13% above their 5-year average yield. I can see this trading in the low 30s again come next year. We continue to add at or below our book value per share. We bought 6.26 more shares at an average price of $26.25, adding $11.58 to our forward annual dividend income at a yield of 7.1%. Next, we have TC Energy Corp at 7.6% of our portfolio as our last pipeline play in the energy sector. It is up 7% on the month and was the clear performance winner of the 3 we own. This has continued to create new lows and lower highs about every 3 months, creating a nice downward channel. Q1 earnings were good as reported at the end of the month. They reaffirmed their yearly guidance. EBITDA was up, EPS was up, and cash flow was up. Coastal GasLink project is now 80% complete. It will be a relief once it is. we dripped 2 shares at a price of $54.08. That added $7.44 to our annual dividend income at a yield of 6.9%. Dropping to our fourth largest holding is First National Financial at 8.1% of our portfolio. It finished the month up 2% again. Earnings were released at the end of the month and I was really surprised. MUA, or mortgages under administration, were up 7% to all-time highs and revenue up 23% year over year. Revenue and total assets were at all-time highs this quarter, but only marginally up quarter over quarter. The common share payout ratio was 84%, which is okay for the industry, but not as healthy as it was when the real estate market was booming in Canada. The outlook was also muted given the real estate market that they are operating in. With 11 years of dividend growth, I see them continuing to grow as a small to mid-cap in the thrift mortgage industry. We will look to continue to add to this position in the event of a major pullback. Otherwise, we are happy with this position size. Next up, we have our mid-cap utility, Capital Power Corp, at 8.3% of our portfolio. This has been on a tear since the end of March, up 12% since then. Capital Power will be reporting earnings at the beginning of May. This has been a steady performer for us, with a 12% CAGR on its stock price over the last 5 years and healthy dividend increases averaging 6.9%. We'll continue to buy back our position after selling above $50 a share back in September of 2022. This month, we dripped 1 share at an average price of $43.94. That added $2.32 to our forward annual dividend income at a yield of 5.3%. Second to last, at 9% of our portfolio, is Bank of Nova Scotia. This is our second largest holding, but not forever. We will trim it back. It was flat in April after all that banking nonsense of last month. I'm anticipating poor earnings quarter over quarter when they report in May. This has been the general trend of late. With a 5-year average yield of 5.5% and trending up, and a 5-year dividend CAGR of 5.9%, I'll continue to drip or add when this meets our rule of 12. This month, we dripped 1 share at $66.53. This added $4.12 to our forward dividend income at a yield of 6.2%. And lastly, our largest holding remains RIOCAN Real Estate Investment Trust. It is 12.4% of our portfolio. It finished the month up 3% and is basically flat on the year. RIOCAN is in a similar position to SmartCentres, just with a better balance sheet. I love what management is doing, creating value for shareholders by densifying their properties. They have the biggest pipeline of projects, with SmartCentres a close second. We'll continue to add to this overweight position. We were able to drip 2 shares at a price of $20.83 at the beginning of the month. This added $2.16 to our forward annual dividend income at a yield of 5.2%. So there you have it, all 17 holdings we own and what purchases we made in another crazy month. We deployed a total of $786.57, adding $45.64 to our forward annual dividend income this month at an average yield of 5.8%. If you watched our April income update, you'll notice that we spent less than we earned this month. That's because we received some dividends at the end of the month. We have almost $57,000 in Tfsa contribution room we're trying to deploy on undervalued stocks in our portfolio. I have plans on adding 2 new positions next month in the event the price is right. Let me know in the comments below what you guess we added to the portfolio. As always, thank you so much for watching and helping the channel out by smashing that like and subscribe button. Until next time, I'm Mr. Financial.